Hello and welcome to the Investing Master Series. My name is James Boyd. Alongside me, my good friend Barbara Armstrong in the chat. We welcome her. So if you see her initials as BA, you know that's Barbara Armstrong, a fellow instructor. We welcome all of you here on this January 20th. Some of you actually said how cold it is where you are. Just got to get through January. Once we get through January, it's just upside from there. So a little fun. Hopefully you enjoyed your 3-day weekend. A little game last night. Boy, that was a game, wasn't it? My goodness. Who's yours? Okay, that was pretty good. Anyway, hello, Gary, to you, Grace, Talon, Will, and many others. Welcome to all. Now, remember, Barb and I we do post educational content on X. There's my handle at James Boyd CS. Barbara will actually post hers in the chat. That way you can just click on it and follow her as well. Now, just real quick as we get going, remember that with what we discussed, we'll talk about stocks and options. If we bring up options, remember that options carry a high level of risk and are not suitable for all investors. The information provided here is for general informational purposes only. Our examples will be done on the Paper Money software application, and we're going to do that for educational purposes only. Now, as we do this, we'll talk about stocks and options examples. So we'll show you how to use the software, okay, where to get that software, and a lot of other important things as well. Now, also remember that investing involves risk, including loss of principal, so risk is a part of it. And also understand when we talk about examples, they are just that. If we bring up, let's say, short options, whether we sell puts or whether we do covered calls, those can be assigned at any time at expiration or prior to expiration. And that's very important. Now, if you do get assigned, like maybe some of you did this weekend, you're actually going to get a little email about that and say you've been assigned. That might not necessarily be bad. You might say, I'm fine with that. But just understand that could be prior to expiration. Now, we'll talk about the market conditions. We'll start with the VIX, as many of you actually want to take a quick peek. And then we're going to talk about kind of some current opportunities in the marketplace, but also we'll review a couple positions that we need to talk about in terms of management. Now, before we actually dive into the market, just briefly, I want to pull up some resources. So first off, if you said, hey, where would I actually go? And there was a question on this. Where would I go to find this, like these classes? Well, we're on YouTube. It's streamed through YouTube. And so if you went to this page, you're going to see that in the middle of the page, if you have not subscribed already, you can just click subscribe. Anything that you subscribe to, that doesn't necessarily mean you pay for it. Some of them are free, okay, like ours. What you're now going to notice is if there was a live class going, and I'll refresh that, you're now going to see that this class, which we're doing live now, is streaming on our home page. So if you're ever on YouTube, which I know you are, me too, you're going to see it's right there. Okay, now, second thing, where can we actually go back and see prior playlist from this class? Well, this class, so just like your favorite TV show, there's a playlist for that. These are our prior classes that are recorded. So I just sent you that link as well. Now, also, I'll mention one other thing about this tab here in a moment, but let's kind of go into the markets, but I think that should set us up. Now, first off, let's talk about the VIX first, okay? Now, this is a very good gauge on kind of what we're likely going to be seeing. So when the VIX, think of this as investors' anxiety, expectation of price movement. When this goes up, usually people get they have anxiety, fear, whatever you want to call it. And if this chart is going up, prices are pulling back. Now, sometimes that can kind of create some opportunity, okay, which we're going to talk about. Now, if you take a look at these little movements, so let me just kind of take this. There's been times where it's spiked up, spiked up, spiked up, spiked, spike, right? Spike. But the thing is, when it gets above, we've always said above, probably about 18 or so, those spikes, fear doesn't necessarily last forever, okay? And we saw with some news about Greenland, among other things, we saw that the market was not anticipating fully what actually happened, and the market's volatility went up. Now, we're looking at the S&P 500 volatility, okay? So now we actually get the VIX up. And so the investors probably now thinking, well, if we saw stocks, what are they probably doing? Well, if this VIX is up, this is really saying that many stocks are probably pulling back, Now, I just want to kind of give you a quick observation. I've wasted a lot of time worrying about the markets when they pull back in the short term. As we'll see in just a moment, in an upward trend, there's going to be times where the market gets caught by things they didn't expect. It just is a part of the market, okay? It's like running a business, for crying out loud. Now, if we take a look at, let's say, the S&P, what does this look like? Well, if we saw this chart, you're going to see that as the moving averages of the VIX was up, just like we would kind of expect, the moving averages, which I'll share with you this chart in just a moment, the moving averages are the whole moving averages, okay? The line that I'm pointing to, that's the 20 period, and that's the 10 period. And so what you're now going to notice is on the S&P 500, really going back to, like, say, Friday at the close, it closed down where the shorter term moving average was below the 20. So a negative crossover, okay? Now, it didn't break support, but it closed down and crossing below, the 10 crossing below the 20. Now, I want you to also pay attention to where we are now, okay? Now, if you look at this, you're going to see that on this chart, we've kind of fallen right back into this consolidation area. So when things drop, as an investor, you're thinking, man, I kind of wanted it to drop because I wanted to kind of get in some stuff. So you are looking for shorter term negativity like this, where the price is still in an upward trend. That's critical. Now, do all things fall the same? No. If we actually go look here on the left-hand side, just real quick, S&P 500. S&P is really down about 1.24%, which is tech heavy, we know that, and discretionary heavy. By the way, those two sectors would be the ones that would actually probably go down the most. And if we look at which ones are down the most, we see discretionary, IXY is down. You're also going to see that technology is fifth from the bottom, down 1.27. They're down there. So the biggest actually thing is when you look at the S&P down about 1.17, NASDAQ 1.13, Dow about the same, and you're going to see the Russell down about 0.7%, SOX, semiconductors, barely down. I mean, literally down, 0.2%? And if you look at, let's say, gold up 3%. This goes back to when things go down, some people try to buy things that are not as correlated, per se, to the stock market. Let's take a quick look, okay? So when we look at gold, which we said kind of talking about maybe 5,000 about 3 weeks ago, well, we're not at 5,000 yet, but it got closer overnight, okay? So there's gold. The precious metal stocks probably get a bump off that. They could. The silver, hi-ho silver, that is not at 100. Someone actually mentioned 100 last week. It's not quite 100, but it got closer. Grinding away to the upside. Notice the differences in the moving averages, right? The S&P 500, red moving averages. The moving averages here, green. The investors trying to be in stocks or positions where the moving averages are green and the price is above both moving averages. Now, probably something else that was a little startling today was the interest rates, okay? And we saw that the interest rates jumped overnight as Europe kind of set their foot down a little bit. We saw Swiss franc go up, euro go up. Our rates here in the U.S. jumped. And this is the rate that us as consumers, we borrow off this rate, right? Maybe it's a car loan, things like that, housing loan, things like that. Also institutions. We also did see the U.S. dollar drop. So here it is, fully looking at it. We kind of see that as we saw what happened over the weekend, U.S. dollar drops, European currencies actually rise. We actually see our interest rates go up, gold up, silver up, and equities, for the majority, push down. Okay? Now, as I bring this up, let's kind of now I need to talk about two positions. Now, if you follow us in this class, we actually have two different portfolios, and I'll show you those. Let me first share with you, so we can be all on the same page, this chart or charts that you're showing me. Where do I get it? Well, this right here, I'm going to click on this. Let me share this grid with you. Think of these charts as like tools in a toolbox, okay? So this right here, what you're now going to notice is I sent you the link. Now, if you go up to the very tippy top, if you've downloaded the platform, the software-based version, go to Setup, Open Shared Item, and now what we're going to see is we're just going to copy and paste that back in, what I sent to you, okay? Now, some of you might be wondering, like, I actually don't know where to actually get that download. Where do I download the software? Well, if I go to Accounts and Products, so if I'm on schwab.com, okay, just so we can all be on the same page, if I go to, let's say, I haven't even logged in, schwab.com, Accounts and Products, and you'll see right there, Thinkorswim Trading Platforms. This is a software. You download it to your desktop. If I click on that right there, scroll down, you're going to see log in to download. Now, when you log in, you're logging in with your username from Charles Schwab, okay? But that's the platform that we're running right here. Just want to make sure we're all on the same page. All right. Now, once we do that, we just say preview and then import. And then we actually have that on your side. And you can save those, okay? So what you're now going to notice is you could say, look, I'd like to save this. See at the very top right, you get these little boxes. And you could say save grid as. All right. Save grid as. And what I'm going to do is I'm just going to call this, we call it the package of charts. And if you don't mind, I'm going to put 2026. Okay. Save. Go back to those little those boxes. And there it is right there. All right. So not too bad. Now I'll probably swing around and show it one more time in a little bit. Now, let me kind of actually pull this up because we need to talk about this. Now, the question we got to ask ourselves is, well, when the market pulls back like this, are you talking about putting on new positions first or looking at existing positions? Does anybody know the answer to that question? I'll tell you what the answer is. The answer is we're looking at existing positions, okay? Because we want to manage what is in the current portfolio now, okay? We don't want to mismanage. Now, the one thing I want to kind of point out here is I am on the Monitor tab, which monitors our orders and our positions. All right, so monitoring orders and positions. Okay, now I need to talk about two stock positions, okay? Now, what you're now gonna notice is these are stocks, okay? And the one of them that kind of was a little ugly here today was, number one is, I'm just gonna pull out, just for our example, is we see the Google, which it's gonna show a red box for the 10 whole moving average. Now, what is that telling us? Well, the fact that the background of that box is red tells us that the moving average is red. It's not great, okay? The number in the box is actually telling us the number of trading days that it's been red. It's been 2 days, so it's really been Friday and today. Now, the other thing is the 20-day whole moving average, that is still green for the last 17 trading days. But there is some weakness in the shorter term, thus the 10-period moving average. And the other weakness we actually see right here is we see a whole moving average cross. And it's happening today, or happened Friday. So remember, so you got to think when the VIX actually goes up, there probably could be some positions that could be manually exited, okay, or stopped out. Let me show you two, okay? Because it wouldn't be fair to talk about the entries and not talk about the exits. I mean, it'd just be incomplete. So let me show you what this looks like, okay? Now, the hardest time as investors we have is when to sell. Well, we don't really look at it like that, okay? It's not when to sell, it's did you follow the rule set, okay? So what this looks like on the chart is when we pull up Google, okay? There's the red line on the moving average. There it is right there. There's day 2 right there. So it hasn't crossed yet, but the moving averages are pinching. So the fact that the 10-period moving average goes red, we call that 1. This is the earliest sign of exiting. If the moving average crosses, example given, then that would actually be 2. That there's actually more confirmation of selling pressure. Okay? Now, if someone wants to get out, earliest sign, sell in number 1. If someone actually says, I want to sell when there's a little bit more confirmation, the investor might say, I'm going to sell in number 2. The problem with selling number 2, to get the confirmation, it had to pull back more. This is not you can't read the chart. This is can you actually discipline yourself to trade what you see and have confidence in it. Now, if I go to the next day, you're now going to notice if I go to the very next day, that's what it looks like. So what you're now going to see is we've now gapped down. So we're in step number 2 of 3. What is 3? You didn't say 3. Well, 3 is when that 20-period moving average goes red. So if you said that, look, I want to see more confirmation, which means that price has to pull back more. Well, if you wait for 3, it means it could be lower. And that means you give back more and more and more to get the confirmation. Now, one of the things we actually said is if the market drops, an area that the investor might say, I'm going to try to get out of is technology and discretionaries. Does anybody know why? Well, the answer to that question is because those are typically more volatile, okay? So in our example, what we're going to do is we're going to get out on number 2. Now, I said this, we were going to do this more often this year. I'm going to cancel these stops. And what I'm going to do, and I'm canceling those stops by just clicking on the X. All right, there it is. So how do we sell the position? Why are we selling the position? Well, we're selling the position because we are on step number 2. And I said before that we're going to practice selling in step number 2. It's kind of more medium confirmation. It's not the earliest sign, but more confirmation. If I go back to the monitor tab, how do we sell it? Well, we're going to click on Google, okay? We're going to right-click on those shares, 24 shares of stock. We're going to go sell Google, and now what we're going to do is we're going to go ahead and sell. Now, question was asked last week, which column headings do you like the most? Don't ask me questions like that because I'll tell you. Okay, I like the 10-hole counter. I like the 20-hole C for counter, and I like the whole MX because it is really visually showing you what's actually on that chart. Now, scripts are not guaranteed for accuracy or timing. Verify, we did on the chart, so it's showing correctly. We're going to right-click on this, create closing order, and now sell. Now, just because we want to sell doesn't mean it's going to fill, okay? So if I now go to the trade tab, now we're going to say sell those 24 shares at what price? We're going to try to get in the mid or the middle. The mid or the middle is in between the bid and ask price on the stock, okay? Now, if I do that, go confirm and send. Notice there's not a commission to sell the shares. We're just trying to get the capital back, okay? Now, in that position, if we sell now and get filled, you're now going to see in the margin account, there's 217 shares. Right-click, create closing order, sell. And if we did that, move it back, confirm, send, send. You're now going to see that that position is sitting right there. We like to give these maybe 2 to 3 minutes to see if it's going to fill. If it doesn't fill, we'll go in and adjust the order. Now, here's the problem. I'm not going to spend a lot of time on it because it's not different. But if we go to the IRA, you're going to see that there's 100 shares there as well. We're going to sell both. So there's my stop and there's my stop order. Okay. I'm going to right click on that, cancel the order. We can do this faster now. The 24 shares sells. We're just going to sell these ones too. Create closing order, sell. Same idea, just more shares in a bigger dollar account. Move it there, confirm, send, there. Now, again, we put the order in. We're going to see if it fills. All right. Now, let's kind of go back to an example that we want to bring up. So I'm going to bring up one more trade example, but let's talk about a new example. Okay. Now, if you're watching this for the first time, I need you to have full understanding of where do we get stocks. The answer is where do we get stocks? We get them in the Dow 30, which is on the left-hand side. Dow 30. Okay. Now, if you said, I don't have that in my list, where can I get that? Well, first off, when you click on the 3 lines right there, you can go to Switch Gadget and you could say, give me a watch list. Okay. That watch list, once you do that, we can click on the drop down there and just go to public and just bring up Dow Jones. The reason why we want to focus on Dow Jones, NASDAQ 100, S&P 100 stocks, they tend to be more liquid on a stock basis, on an average volume. They also, if we considered maybe do options, they might have more liquidity and the bid-ask spread tend to be tighter. So that's the list we use. Sparingly, we use the S&P 500, but pretty much, I'd probably say 95% of our examples come from Dow 30, NASDAQ 100, and the S&P 100. No mistake about that, okay? Now, let's actually pull up an example just real quick. I'm going to pull up just real quick. Okay. Now, we know that if we pulled up stocks, now if I were to ask you a question like, what is the trend on the semiconductors? Okay. What is the trend on the semiconductors? What would you say? Is it neutral? Is it bearish? Is it upward trending? What do we got? Well, I mean, kind of fell down this morning, but this kind of looks like it's been like an upward trend. Okay. Now, does that mean all the stocks in the neighborhood of semiconductors are going up? No, not necessarily, okay? We said last week that NVIDIA kind of looked like it was flat to maybe going down a little bit, maybe flat at best, perhaps. But there's been stocks in there like MU, which have really gone to a brand new upside here today. And then you get another stock like AMD that they've actually done pretty well as well. Now, let's look at this for just a second. Calling all technicians, okay? If we looked at this chart and we want to talk about using volatility as an opportunity. Now, I'm going to tell you right now, when I first got started, volatility was not an opportunity. Volatility exposed that I didn't know what I was doing. Volatility going up made me fearful because I didn't know really what I didn't know. When you see this over and over and over again, you have to understand that really when the market, when the VIX volatility goes up, it's actually getting people maybe to get out of the position and driving the prices down. And this is why it's critical to find companies that are real businesses, not just stock ticker symbols, but actually real legit businesses that might be getting more market share and actually having new products and services to drive sales. Okay? Now, if we looked at the old resistance, what would you say the old resistance was on this chart? Well, the old resistance on this chart might have been in the area, maybe, let's say 223 or so. All right. Now, were you thinking the same thing? Now, if we looked at this chart and actually said, okay, what type of candle do we actually have here today? Now, it's kind of unusual because like many stocks, AMD opened up lower. But what was the reaction from opening up lower? Someone bought closer to support and then pushed the upside. Now, this is where we are now. We haven't closed here, but this candle, this is what technicians call really a bullish engulfing pattern or candlestick. That bullish engulfing candlestick is engulfing Friday's red candle. Some might say that's a pretty strong candle, given that it was at old resistance, new support. Now, I want to kind of go over something. If you said, hey, James, I want to go back to one thing. Let's go to Learn for just a real quick. So I'm going to go to schwab.com, and I'm going to go to Learn, and what I'm going to do is Schwab Coaching, okay? Now, if you said, hey, where do I find different classes that you taught and who are different instructors, etc.? Here's a visual picture, but let me also show you a calendar. Now, I'm going to show you this calendar because I want to reference something to you, okay, in just a moment. So what I'm going to do is I'm going to go to live webcasts and virtual workshops. Live webcasts, like now, okay? Now, if I click on this, and let me send this to you. So if you said, James, send me that link, I'm going to actually scroll down here, and what you're now going to notice is each day we have different classes. Now, those different classes could be actually based upon a coach that is teaching. It could be based upon, let's say, a type of product that you want to learn about or skill level. All right. So it's kind of nice. Wherever you are, there's where we are. Now, I'm going to go to actually Coach James Boyd. Why? Well, because I want to show you something. Now, what you're now going to notice is one of the things that we talked about, and I want to reference this, is going to be, so two things that I want to talk about, okay? So number one is we talked about verticals, which was the 13th, a week ago. You're also going to see that what I really want to point out, because we're going to practice this right now, is really the simple guide to practicing short put verticals, okay? And that would actually be something we could actually, and I also want to reference what we did 2 weeks ago, which is that one, which is selling puts, also known as short puts, also known as cash secured puts. So these two strategies, when the volatility goes up, one of the main strategies that some investors might look at is short puts and verticals. Now you might be saying, well, why in the heck, why would I be looking at those? Well, because these are the sample plans. So I want to now put in action what we talked about with the sample plan. If you say, I don't have a sample plan, well, homework assignment number one is I'd watch that date right there, the 6th, and I'd watch that 8th for sure, okay? Now, let's pull this up here and let's practice this. So if we get something that's basing and starting to actually break out, now this right here, that icon right there, that's earnings. Now I know there's gonna be some people, I'm so concerned about earnings, okay? Well, that is in 2 weeks, noted. If someone was so concerned about it, they might say, might I do a short put vertical? Now, that sounds complicated, but really it's a short put. You're selling a put where you think the stock could stay above. Type in the chat where you think the stock could stay above. Takers on that? Wherever you think that stock might stay above, that's the strike that you might try to sell. Now, if we go to the trade tab just real quick, let's go to the trade tab. We're going to do a trade. Now, when you go to the trade tab, we can do a stock position right up top, stock, or we could actually go down here below to the options. Now, what I'm going to do is I'm going to type in this position, right, AMD. And when I type in AMD, what I'm now going to do is we said on the sample plan, we're going to go down 20 to 50 days to expiration, the monthly options. Some of you new people here, you might say, well, I don't know which ones are the monthlies. They're in the white color, okay? Now, we got calls on the left, puts on the right, and what we're going to do is we're going to say, okay, where do we think the stock could stay above? Now, Frank says 220. Jack says 220 as well, 200. NY Josie 42 says 230. Now, what I'm going to do is we went to strikes all, and the strike that we're going to sell is we're going to try to sell where we think the stock could stay above. Well, if I went with a couple of these answers right around 220, it would really be about a 725 bid price, 805 ask price. Now, we said we want these spreads to be narrower than how much? $2, $1, or 20 cents. Answer? 20 cents. Okay. What we're going to do is we're going to right click actually right on that. We could right click right on that bid price. We're going to go to where it says sell and then vertical. Now, one of the pros of this is when you sell a vertical, you're selling a put where you think the stock could stay above, collecting a premium, but the vertical is creating downside protection and a built-in maximum loss. Now, I don't know about you, but how many of you like knowing that if it went down to zero, it's not some $20,000 loss, but it's a defined risk? Now, what does that look like? So if I said in this case, hey, we're going to sell the 220, and then what we're going to do is we're going to buy, let's say, example given, the 210. Now, why did you go down to that? You just said that. Walk me through it. Well, this doesn't have any open interest. That doesn't have any open interest. This doesn't have any open interest. You see what I'm saying? We're looking for liquidity. It doesn't have any. So we're going to come down here and buy the 210. So when we do this, we're selling a put, thinking the stock could stay above that, getting a premium. Then what we're doing is we're paying for the put below. Why? Well, because this is where we have an obligation to buy the shares at 220, and then we have a right to sell at 210. Now, what's the credit of this? $285. So if we look and see where the stock is right now, now listen, you stock investors, you need to understand one thing, okay? If we buy a stock at 238, the break even is what you bought the stock for. And if it doesn't go up above break even, you don't make any money. Well, this should be like a light coming down from the ceiling. This actually has now a break even at $217.15. The stock could come down $20 and be above break even. The way it makes maximum gain is the stock is above both strikes, notably the 220. Okay. And then if the stock were to be below the 210, that lower strike, there is a built-in max loss. All right. Now, what we're now going to do is we're going to do one contract. We're going to assume that we could risk 1,000. If we could risk 1,000 on the portfolio, and each contract being $715, we could do one contract. Note there, the commission, $1.30, 65 cents per contract. Now what we're going to go ahead and do is send the order. Okay, now just because you put the order in doesn't mean it's going to fill. And you're now going to see with our, down here, we can now see the position filled. There it is right there. Now, are there any questions? Okay. Now the comment came in, I'm not able to do a vertical. What should I do? Well, first off, would you consider doing it? You might actually ask Schwab if you could actually get options approval to do a vertical. Okay. You could actually go through that, but also understand that if you said I'm not going to do options, or I just maybe comfortable with a covered call, which is a different level of options approval, we're going to show that as well. So now what I want to do is I want to bring up an example here. I want to also go down to, let's say, just real quick, and this has kind of been a little fun. We've had a little fun with Intel. Now, if you kind of said what moving averages are your favorite color, you're going to see that, man, when those moving averages, they cross and there's that green shading right here, I'm going to tell you something that I've learned through the school of hard knocks. Man, to get big gains, you got to ride big trends. And to ride those big trends, you gotta be comfortable with letting those prices fluctuate. And every time you see a red candle, it doesn't necessarily mean that the trend is over. Now, Intel, you're going into the earnings right there coming up. And so this, we have a position in this. Super quick, where does it stand? That position on Intel, if I pull that right back up, let's go to there, it should be here. There it is. A couple dollars. Now, I got to ask you a quick question. On something like this where there is earnings coming up, what might you consider if you said, hey, I can't protect it per se outside of stop? Now, you got to remember something if you said, I don't have 100 shares, okay? I'm not going to do options. If I set a stop that locks in gains, it doesn't lock in anything. That's the risk of a stop. So let's go back to something just real quick. When are these earnings? The answer, they are on the 22nd. Now, the problem is people bought the stock in anticipation of what the earnings was going to be. Now, that's why I married my wife, because I had built-in expectations. Now, don't think it was just me to her. She had expectations from her to me, too, right? And that's why we bought each other a ring. That's why we got married, and investing is very, very similar. It's not what did you do for me 20 years ago. It's called what are you doing for me what? Now, if we take a look at this, in the paper money account, what we're going to do is we're going to sell this position because even if we set a stop, the risk of this is, well, it doesn't matter, okay? It could gap down. Now, what I'm going to do is I'm going to come in here, right-click, okay, create closing order. We cannot protect this. It's not going to be enough. And even if we said, hey, I'm going to buy a put or something like that, they're going to be too expensive. The implied volatility is way above what we talked about. So we're going to come in here and grab that $368 and try to stuff it right in the paper money account. Create closing order, sell. Now, when did you put the position on? Answer is we put the position on the 8th. What did that look like on the chart? Oh, the 8th, it was about right. Let's see if it's consistent with the sample plan that we talked about. It was right there, okay? Now, we can now see that this was a red candle. The problem is maybe when we did that, maybe the candle wasn't red. Maybe the candle was up slightly for the day. By the end of the day, it was down, but it was still bought on something where we had a crossover, bullish, green moving averages. It was bullish. and it ran up a little bit. Okay, now people said, I remember, and you remember too, it's too high, too high, too high, and it went up higher. Okay, so we're going to come in here. We're not going to hold over earnings, can't protect it, sell, and now what we're going to do is going to try to sell at the mid price, confirm and send, and now what you're going to see is we're going to send the order. Now, again, a lot of people talk about putting positions on. They don't talk about things like managing the position. They don't talk about how would you trade around and around earnings if you had maybe a small position, and that's what we just did here. Now, what I want to do is let's kind of talk about another position, maybe like a new position, and what I want to do is I want to come back to, let's say, a stock. Let's go look at, let's say, the space just real quick. Let me look at AMAT for just a moment. I want to just look at also just a couple of these stocks, okay? Now, one of the things that we're actually seeing is, I'm just going to pull up a stock like WFC. Okay, now, I want to look at this for just a moment, okay? Now, this has been a stock, when you look at this, that is actually fallen down near the old level of support. Would you agree with that? Where was the old support resistance? Where would you say that it was? Now, you're going to kind of see on this that we've had earnings. That's why there's a telephone sign with the 162 earnings per share. Now, let me show you a different chart. This, if we go back, hit the back arrow, this is really going to show us this chart, okay? And it's going to show us that the lines, the color of the candles is showing what type of trend that we have currently, which is red color candles. The red color candles are telling us currently the sellers are in control. All right, now, the sellers in control and the price is below both moving averages. So when I ask you the question, where do you see support? Old resistance, I was kind of thinking right around about $80, $70, $88. So if we're saying the same, about within 1%, we're probably looking at the same level. Now, sometimes, how many of you like to buy stocks on a pullback? Anyone? Repeat the question. How many of you like to buy stocks on a pullback? Now, just because it pulls back in the short term, does that mean does that mean it's over? No. Okay. We can pull up stock after they pull back, and the investor looks back and says, geez, I wish I would have gotten in. Now, let's take a look at this. So first off, we went through the earnings. We went through it. So step number one here is we're going to try to buy some shares right near right near the old support resistance area. So how do we do that? Well, we're going to go to the trade tab. We want to do a trade, we're going to go to the trade tab. Click on the trade. Now, what I'm going to do is I'm going to type in WFC. Now, once I type in WFC, now I said this before, okay? A lot of times when stocks have pulled back, just be honest with James. I close my blinds for a reason. I'm not going to tell anyone what you tell me. How many of you are like to get in, but you're scared? Be honest with James. Now, if you said, James, I'm scared. I'm telling you, that's what I was, okay? So what we're going to do is we're going to practice a position that is really buying the shares and then selling a call. But at the same time, we're going to buy the downside protection. Because if this doesn't stop going down, we want to know that there's a floor of risk that's not down to zero. Are you with me? Now, how many of you are thinking, my gosh, if someone would have told me that before, I would have gotten in so many pullbacks, it's unbelievable. I know. This is our first day together. Hi, my name is James. Now, the biggest actually thing is let's go to the trade tab. Step number one, we're going to click on the ask price. We're going to buy the shares of stock. Now, in this example, we're going to buy 100 shares. It sounds like a lot until I tell you that the shares are $88. Now, 100 shares of stock, there it is down below in green. Green actually means that we're buying. Now, this class, one of the things we wanted to cover is using volatility, using price fluctuation as potential opportunity. That's kind of what we've talked about. Now, what you're now going to do is I'm going to say single order. We're going to say first triggers SEQ. SEQ stands for sequence. First triggers. So first, we want to buy the shares. Second, we want to put on an additional order to overlay on top of the shares. Now, what do you mean by that? Well, let's do this. Let's open up the monthly options, the 20 February 2026, that has 31 days to expiration. Now, I like that. John says, not scared, just highly skeptical. Trust me, I can look through a keyhole with both eyes myself. Now, here we go. I'm skeptical too. I lived in New York and Kentucky, but I was very close to Missouri, the show me state. So I feel what you're saying there. Now, what I'm going to do in this case is we're going to sell the $90 call. Why did you pick that? Well, that's the one that has some liquidity on the open interest. And when we talk about selling that $90 call, well, that's the one that has a probability between 30 to 40, here, 39, to be 1 penny above the $90 strike price. All right? Now, the downside. Well, what I'm now going to do is on this is I'm going to come over here to the put side. The put gives us the right to sell those shares at that strike price. Now, let me open this up for just a second. Now, if we take a look at this just real quick, the ones that are the most liquid on the put side are which ones? It looks like the 87.5 and it looks like the 85. All right, so let's do this. We're going to right click on the bid of the $90 call. Okay, sell. We're going to go right to where it says caller. Okay, now when we do that, this gives us the obligation to sell the shares at 90, and it also gives us the right to sell the shares at 85. Okay, now, James, when we did this, when we right clicked on that 154, sell caller, it came up where both strikes are 90. Well, you'll see a drop down for the put. We're going to go to 85. All right, now watch this, okay? I'm telling you right now, I've done this for almost 30 years. If you think about how many pullbacks that you've missed the opportunity because you were scared, because you actually said, oh, look, maybe the risk is too big. This is the way some professional investors, some investors have experienced, they actually trade. They buy the shares too, but they overlay options as protection. It's up to you to decide if you want to do that. Now, what you're now going to notice is, let's draw this out. Nice and easy. Well, if we bought the shares at 88, now we can all do basic math, right? Well, if we buy those shares at 88 and we agree to sell those shares for 90, well, that would just be $200 or $2. Okay, 200 because it was $2 per share, you got 100 shares. Now, if you look at the downside, we have a right to sell the shares at 85. Basic math. If we buy the shares at 85, we actually have a right to sell them at 85. It's going to be $300 down. So you're now going to see, is it done for a credit or a debit? Well, I'm just going to say it's closer to zero. It's 9 cents, but when you subtract out $1.50 commission, it's closer to zero. So this trade, if it were to close above the 90, has a $200 potential upside. If it actually closes below the 85, it has a $300 defined risk to the downside. Now, normally, we'll probably see that reward to risk is about neutral-ish. But now if the stock goes up, down, up, down, up, down, it doesn't really matter, because really the way that it makes the most money is we want the stock to go up and close above 90 or trade above 90. And if the stock were to close at $80 flat or 75, the most we could lose is $300, given the caller. Okay? Now, this is, you know, when stocks pull back, some people like using these callers as a way to try to play a bounce up trade, but defining the risk. This trade is very vertical-like, but the maximum gains are bigger because you actually own, and loss, because you own the shares. Okay? Now, by the way, James, wonder if Wells Fargo paid a dividend. Could you get a dividend maybe while you're in this position as well? You could. Just always remember that dividends are not guaranteed indefinitely. Noted. So last trade we're going to do here is go confirm and send. And we're going to put on the second trade, buying the shares of Wells Fargo near the support area. And we're going to see if it can't bounce back to the upside. So I'm out of my time here today. But I want to make mention of something we actually said before. So if you said, James, where can I actually go back and also try to actually learn more about that defined risk. Well, it was actually on the class right there of December 30th. That actually gives us a detailed plan on callers. So if you came here today for the first time and said, oh, geez, I didn't know this was out there, and I didn't know that some of these sample plans were given just recently, make sure that you use that schwab.com webcast section, and you can actually grab those. Merry Christmas, Happy New Year to you, by the way, just to start the year with those. Now, remember that coming up next, let me kind of show you the layout for today. So if I went back to live webcast and virtual workshop, today, what do we have going on? Well, today, here we are on the 20th. We actually did the Investing Master Series. We got coming up, Getting Started with Options. We also have long options. And then also Barbara, who is with us, will be doing a class on getting started with technical analysis. I want to thank you for actually coming to today's session. In the chat, there's a quick survey, just 2 questions. Thank you in advance for filling that out, okay? And also remember that with what we discussed here today, it was done for example, illustrative purposes only. So as we talked about these things, our strategy that we focused on was a cash secured put with downside protection to define the risk, but also looking for something that's pulled back and maybe trying to bounce back to the upside and trying to create defined risk as well. 2 bullish trades trying to take advantage of short-term volatility. So with that said, thank you so much. I wish you a great day. Thanks to Barbara, and stay tuned for Cameron coming up next. Join us again next week, same time. This is not a one-off class. We meet every week. We actually have set topics. So we look forward to seeing you again. And don't forget to subscribe as well. Take care. Bye-bye.